time to bring on board Shankar Sharma, Chief Global Strategist with First Global. Shankar, good morning. What a delight to have you back on ET Now, and thank you for joining us from Dubai. Shankar, what do you make of Friday's price action? US Fed has ensured that in the near term global liquidity is here to stay. Do you think what global markets and what Indian markets registered on Friday, those gains are here to stay?
See, the liquidity in global markets has always been plentiful in the last 4 odd years since this crisis started, actually from 2007 onwards. So I don't think anything new has happened. All they have said is that they will continue to maintain liquidity, inject a little bit more, keep rates low for another 2 years, which is to be expected. So I don't think anything very dramatically different from what we have seen in the past 4 or 5 years has been announced. So I think that's just pretty much normal.
So Shankar, are you saying that last week's price action may not sustain?
Well, that always happens, that when you have coordinated rallies of the kind that we have seen, everything runs up. But I don't think that sustains. Eventually the asset class that has to go up will be really markets like India rather than the entire world being pulled up because of this. So while on day one of any such rally you will find almost everything participates, that participation starts to cool off, in the ensuing 4, 5, 10 trading sessions. So I think you will see that happen here as well.
Now, Shankar, the good news here is that Indian markets are up 20% this year and we've got record inflows irrespective of the fundamental turf. The bad news here is that despite record inflows, the markets are getting extremely polarized. 80% of the market is not going anywhere, 10% of the market is going down, and only 5% of the market is moving up, which is large cap FMCG, select pharma, and to a large extent large cap IT.
Look, in markets we can't dictate which spot in the market does well. I mean, from our perspective, what is important is that we have to be in those right places. That is really all important. We can't say that why is Hindustan Lever, so much higher. Go back to your own shows, and I have said this very clearly, that whilst for a quarter or 2 quarters you might end up underperforming when you buy an ITC or lever. In an India of today, I did not see this, say this 10 years back. In India of today, when these stocks underperform, that cannot be a long-term underperformance, because they have realigned their strategies to suit the new India, which is a consumption-driven India. So, we might not like them at 40 times earnings, but that's not the market's problem. That is our problem if we are wrong on that trade. So we have to essentially read the mind of the market. The right mind of the market has been very clearly biased towards them. It's been biased towards, select pharma stocks, select auto stocks. It's been biased against telecom stocks, biased against metal stocks. So you can keep arguing against the market, but we get paid to be sort of riding with the market rather than be arguing against it permanently. At crucial points we need to argue against it, but not all the time.
Shankar, so far UPA too has been a clear disappointment. Do you think now they will surprise us from here onwards?
I would totally disagree that the UPA 2 has disappointed us. It has disappointed a handful of economic commentators and foreign houses, strategists and economists. But go down to the grassroots levels in the villages, rural India has never had it so good as it has had in the last 8 years' time. And frankly, all of us are sitting here in the big cities and projecting out from those big cities. India has moved. The game is no longer in big cities. It is a small town India that is driving growth. It is rather small village India that is driving growth. Consumption story there is very strong. It has never happened in the last 65 years. So why has it happened just in the last 8 years? It is not because of magic, not because of the 33 crore gods. It has happened because of conscious decisions taken to stimulate rural growth. Even if it means that the urban guy thinks, hey, what is the government doing for me? Urban guys have seen their salaries go up maybe 10 times in the last 8 years' time. What more do they want? It's the poor who were always disadvantaged. It's the poor that the UPA came to power on. The UPA has delivered 100%, if not more, on that front. It is because of that that this market refuses to fall. It is because of that that Hindustan Lever refuses to fall. It's because of that Bajaj Auto refuses to fall. So, I don't know why people, that's the English-speaking media, English-reading media, English readers, end up being so bearish. I go to the small places, my relatives still stay in villages. They have been having a party Farmer margins are really, really strong. They make something like 60-70% margin on producing a kilo of rice, kilo of dal. Where do you get margins of that kind? So I think we need to snap out of this whole mindset that the UPA 2 has not delivered. They have delivered for 70-75% of India. That's what really matters from India's perspective. The city dwellers, you and I, can take care of ourselves. It's the villagers who needed to be empowered. They have been empowered without any doubt.
I'm not sure if I agree with you, but we'll discuss it offline. Let's discuss the importance of investment cycle. Shankar, the fact that investment cycle is broken down, do you think it will affect consumption cycle? Because auto sales have plunged and mall footfalls have been appalling.
No, I don't think the two cycles are correlated at all. I think countries have to make their choices whether they want to foster an investment cycle or whether they want to foster a consumption cycle. China has gone the way of fostering a big investment cycle. India has gone the way of fostering a big consumption cycle. Now look at the interesting aspect that China wants to become India. China wants to boost the consumption part of its GDP and decrease the fixed asset creation part of its GDP. India doesn't want to increase the fixed asset part of GDP on its own balance sheet, which is the national exchequer. It wants to do that only through PPPs or inviting foreign capital. India's decision has been that I will use my precious capital to empower the consumption cycle, particularly in the rural poor. I think it's a great strategy. I don't know whether it has happened because of a strategic thought behind it, but I think the net result of it, and I think the end justifies the means. The fact is that India has a very enviable growth model in which it is really a low capital intensity, declining debt to GDP growth model, which is still making your services sector grow 7-7.5%. And it is, while the agricultural production numbers or the growth numbers don't tell you adequately, the margins in agricultural end of the GDP have gone up quite substantially, which is really putting more power or more money power at the hands of villagers. So I think, let's get out of the mindset that we need to be necessarily an investment-driven economy in order to succeed. We are a services-driven economy. We are a consumption-driven economy. If both those two things are happening with a declining debt to GDP, I'm very happy with that.
The last time when we had interacted with you, you had said that if the monsoon picked up, markets would touch a new high. Do you still maintain that view now that we have reforms as well added to that bouquet?
Well, at the beginning of the year, I had made a prediction that this year we would see a new high. In the middle of the year, I got cold feet and I thought that, maybe 19,000, 19,500 is where we are going to end up. That was because of the drought situation, not because of, all this so-called coal gate and whatever the CAG keeps dreaming up in the middle of the night as to what is a new scam I can unearth out of thin air. So I don't pay any attention to that. Those are passing issues, will pass away. But the real issue was the drought issue, which was worrisome. So in the middle of the year, it's around, sometime around June, I did get cold feet, I must confess, June, July. But again, the monsoon seemed to have normalized at least to a reasonable extent. So to that extent, the fear, the specter of the drought is not that apparent. And the other good thing that has also happened is that now we are seeing very low rates of growth on, let's say, IIP, for instance, which has set the base for a reasonable growth number next year. So you might well see big surprises in GDP numbers, IIP numbers coming, in the next financial year. So, and markets will look to that now because this year is more or less a done deal. We're already in the middle of the year. So nothing very dramatically bad or good is generally expected to happen. Markets will look to the next year. I think because of the low base this year, we are setting ourselves up for a reasonably good-looking year next year on the macro numbers. Markets will probably end up discounting that a few months in advance, which is why you are seeing the kind of market that you're seeing. So, in a nutshell, we have been very bullish on India. We have kept telling all our clients that you have to be overweight India. We have also kept telling all our clients that please encourage the other strategies to be bearish on India, so that the markets keep kind of surprising everybody. And I think that script is playing out beautifully. I'm very, very happy at that.
So Shankar, since you are of the view that the world is bearish on India, do you think it's under ownership? It is really this overall pessimism which will continue to drive Indian markets? Because in the near term, Shankar, it's all about ownership, it's all about expectations, and it is all about perception.
Exactly right. Till people are pessimistic about India, and I think there is a huge number out there. There is a paper called Washington Post. which I don't know why India takes so seriously. I think we should ignore all these, newspapers which are read by all of 10,000 people. They're not the Times of India. So we should just simply ignore all these people, and we should stop giving too much importance to the Time, which keeps putting Narendra Modi as a savior of the country and Manmohan Singh as the killer of the country. So we should just simply ignore all that. Focus on the fact that till the world, or let's say not the world, but the dumb money is bearish on India, I think the India will continue to do very, very well. And that's exactly the script that we are seeing play out so far this year. That despite all the doom and gloom, the rupee was supposed to go to 60, 65. My view at the beginning of the year was that we would probably end up somewhere between 44 to 46. It's not happened so far. But looking at the way the equity markets are, hey, maybe not 44, 46, maybe 48, somewhere in that, we will still take that. Remember, when you're looking at a situation of 60, 65 and you end up the year with 47, 48, 49, anything of that sort, that's a victory. So it's not about needlepoint precision. The other call that we've had is that oil will trade sharply lower this year relative to last year. Our call was between 65 and 75. It went very close to that. It's bounced back, but I don't see any case for a bull market in oil. It is treading water. I think it will go back to those lower levels. Maybe not by this year and maybe by first quarter of next year. That's not really the point. The point is that the oil bull market is broken. The commodity bull market is broken. Both those bull market ending are great news for India, which is again a big part of our bullish story that we've had from the beginning of this year. So far the script seems to be playing out that way. The world continues to be skeptical about India. Strategists are bearish. FIIs, I talk to them, they are still very bearish. And the market keeps proving them wrong.
So Shankar, or rather closer to the calendar year close, which end of the market do you think would be trading higher and which sectors would be underperforming?
Let's talk only relative basis, because if the market is at 25,000, I doubt if too many stocks will be trading 15% lower next year. So let's focus only on relative underperformance. And I think the stocks that we consider being underperformers, I don't see any reason to change our view. I think steel, metals, all these are complete sort of no-hopers. We don't hold out any hope on that front. We continue to like I said, we've liked autos, for quite a while now. And they go through periods of not doing anything, and I mean, we've seen that happen. But by and large, I don't expect them to lag the markets 12 months out. I think they will still be in line, if not a tad higher than the markets. I think consumers will still continue to do well. We've liked Hindustan Lever, even though we downgraded it from outperform to market perform. The fact of the matter is that I think, deep down in my heart, it'll probably still beat the market. We've liked consumer stock like United Spirits. So, that space, generally speaking, we have liked. We have liked the banks, particularly the PSU banks, which have lagged the market, but I continue to believe that yields in India are headed a lot lower than where they are. Then they won't remain at 8.1, 8.15%. They will be probably more like 7%. And that will lead to a huge amount of profits on their bond portfolio. So we continue to like the PSU banks in particular. We've liked ICICI Bank, which has done very well. We've liked infra. So I think those spaces still continue to remain. We've not liked telecom. We've been negative on Bharti, negative on Arcom, negative on Reliance. Again, no real change on that. So I don't think the trade is really changing, and that's the sort of satisfying part, that I don't have to revisit everything that you believe in on a daily basis. These are fairly long-term trends that we have seen, and irrespective of a short-term blip, contrary to the trend, I think next year, same time, these stocks will be higher on a relative basis at least.
An important day today in terms of policy watch. Do you expect the RBI to cut rates today?
I hope so. I mean, I think, my assessment is that Mr. Subba Rao is friendlier with Mr. Chidambaram than he was with Pranab Mukherjee. And, and therefore, I think he may have had a word with Mr. Chidambaram or vice versa. It's about time, a growth push was given. So I would be betting on a rate cut. I think it's on Monday that the RBI meets on this front. So I think, you can safely take a bet that we will see a reasonable rate cut coming up very, very shortly.